Following recent upside surprises for inflation and inflation expectations, at their June meeting, the FOMC decided to lift the Fed funds rate by an outsized 75 basis points. This decision leaves the midpoint of the Fed funds range at 1.625%, against the committee's revised median expectation for end 2022 of 3.4%, their longer-run forecast of 2.5%, and our own estimate of neutral, which is 2%. Comparing the current level of the Fed funds rate with the FOMC's revised year-end forecast highlights the difficult fight to contain inflation the committee sees ahead. This is also borne out in the committee's revised expectations. Only in the longer run is annual inflation projected to be back at 2%. Looking at the detail of the latest CPI report, it is easy to understand why the committee is anxious. May's historic annual headline print of 8.6% shocked the market on release, but the detail of the report is the real cause for concern. Headline inflation over the 6 months to May was 9.5% annualised, or just over 5% excluding energy. This is despite goods inflation ex energy and food having lost almost 2/3 of its momentum since last September's peak, a clear sign of COVID-19 supply disruptions dissipating. Over the period, in addition to energy, the core essentials of life, food and shelter, have offset, their respective annualised contributions having risen 0.5 percentage points. Whereas the labour market continues to show signs of excess demand, with job vacancies a multiple of applicants, the above results point to domestic capacity constraints and input cost pressures related to Russia's invasion of Ukraine now being the primary drivers of US consumer inflation. To bring this type of inflation to heel requires patience, to allow supply issues to be worked through and real discretionary income and spending to soften, or a substantial hit to domestic demand from policy. In this instance, the committee clearly believe time is not on their side. If the committee's Fed funds forecast for 2022 and 2023 of 3.4% and 3.8% prove prescient, monetary policy will be deeply contractionary for an extended period, irrespective if neutral is 2 or 2.5%. Activity growth around trend through 2022 to 2024 and the longer run, as the FOMC contend, therefore seems an extremely optimistic forecast. With the FOMC positioned aggressively, below trend growth during 2022 and a stalling of the economy in early 2023 should now be regarded as the most probable outcome. Whether a technical recession is seen arguably is not the chief concern, but rather the risk that weak growth becomes entrenched. Over the year to May, hourly earnings are down 3% in real terms. In that time, the 30-year mortgage rate has almost doubled and University of Michigan consumer confidence has collapsed. Note as well that pandemic spending on goods has arguably satiated demand that would have otherwise been seen in late 2022 and 2023, given durables and non-durable spending are respectively 22% and 12% above their end 2019 levels. Recent activity data also gives cause for concern. Of particular note, US control group retail sales growth was flat in May, and April's gain was halved in the second estimate. As a result, the Atlanta Fed nowcast of Q2 GDP has declined to 0% annualised. Given Q1's 1.5% GDP decline, such an outcome in Q2 will result in GDP contracting through the first half of 2022. Taking into consideration the FOMC's intent to fight inflation, our expectation that annual inflation will hold up in coming months before turning sharply lower, and the cost to the real economy, we have decided to materially lift our near-term view for the Fed funds rate. However, we still expect the hiking cycle to be complete by end 2022 and be partly unwound from late 2023. Specifically, we now look for a second 75 basis point hike in July, followed by a 50 basis point move in September. 2 more 25 basis point hikes are then expected in November and December, seeing the Fed funds rate peak at 3.375%. While the above is in line with the FOMC's revised rate view, we deviate through 2023 and 2024, forecasting 125 basis points of cuts from Q4 2023 to Q4 2024, once inflation pressures have abated and as GDP growth languishes well below trend. This would take the Fed funds rate back down to 2.125% versus the FOMC's end 2024 forecast of 3.4%. Turning then to markets. Term interest rates are likely to peak ahead of the last Fed funds rate hike. From 3.5% at September, we forecast a decline in the 10-year yield to 2.3% at end 2023 and 2% at the end of 2024. This trend will help to offset some of the risk of contracting activity in 2023, but is unlikely to stoke growth back to trend until late 2024. The consequence for the US dollar is that we continue to see it as being near its peak for this cycle. The DXY index is forecast to decline to around 100 by December from 105 currently. An additional decline circa 5% is then seen to the end of 2023. We'll see you next time.